Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. And as part of the Nasdaq Fund Network's month-long celebration of College Savings Month, I'm pleased to welcome back Tarun, Garg, head of college savings at BlackRock. Tarun, it's great to see you as always. Welcome back to Trade Talks.
Thank you, Jill. Glad to be back.
Earlier in the year, we discussed a bit more about the launch of the Ohio State 529 plan with searchable symbols, the importance for saving for college, and what a 529 account is. But today, we're going to take a step further into specific investment options. Let's get started by first discussing what are the different kinds of investment options available inside of a 529 plan.
So although each plan is different, generally speaking, most of the investment options available across plans fall into three categories. One is standalone funds. Think of them as portfolio building blocks. These would typically be funds that invest in a single asset class or a region. So an example would be US large cap equities or emerging market debt. Second category is target risk funds. These are for people who would say things like, I am an aggressive investor. Well, then you should buy an aggressive growth fund. Or I'm a conservative investor, so I'm going to buy a conservative allocation fund. These portfolios target a certain level of risk, hence the name target risk. And the third category is target date funds. These come labeled with a future date. For example, a 2040 fund. That's the date when you expect to start withdrawing your money. So in a 529 account, that would be the year when you expect your child to go to college, for example. Or if it was a retirement account, then the year when you expect to retire. Target date funds are usually the most popular investment choice inside of a 529 or a retirement account. Some plans instead have something called age-based portfolios, which operationally work slightly differently, but they're designed to achieve the same exact outcome.
Let's talk a bit more about target date funds. How do they work?
Fundamentally, all target date funds are based on a simple idea, which is that when you're investing your money for the longer term, say 10 years or more, you can afford to take more risk, and you should take more risk, meaning you should invest more of your money in the stock market. And as you get closer to the date when you need to spend the money, you should start to dial down the risk, meaning move from stocks to bonds. When you invest in a target date fund, a professional money manager does that gradual movement from stocks to bonds for you.
And why do people buy target date funds?
I think the biggest reason is that it simplifies decision-making. My child will go to college in 15 years. Let me invest in the BlackRock 2035 fund. And if I'm saving money each month for the next 10 years, it can all go into the same fund. I don't have to worry about researching investment options, rebalancing, or reallocating my portfolio every few months. It's a set it and forget it solution. And that additional value that the target date funds deliver usually comes with little or no additional cost. For example, in the BlackRock 529 plan, you pay the same whether you put together the building blocks yourself or if BlackRock does it for you. There's no additional layer of fees, which makes it even easier for people to pick a target date option.
All right, Tarun, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.
Thank you.